Hello, everyone, and welcome back to the Direct Insurance Podcast, otherwise known as DIP, a podcast for independent insurance agents brought to you by Insurance Advisors Direct. I'm your host. My name is Kelsey. I'm the digital marketing assistant here at IAD, as well as social media strategist. And today I have a very special guest. My guest today is Robert Intelisano, the insurance doctor. So, Rob, please go ahead and introduce yourself for our audience.
Yes, thanks for having me, Kelsey, and really good pronunciation.
I've been working on my Italian.
Excellent. Bravissimo.
Fantastico.
Yes, so my name is Robert Intelisano, also known as the insurance doctor. And actually, I was recruited into the industry in college. I went to Lehigh in Bethlehem, Pennsylvania, and Prudential came on campus and recruited me. So I was able to knock out all of my exams and everything while still in college, and started off, did very well, and actually spent some time in management where I was training newer agents. So these topics are going to be really good for me, and it's something I deal with on a daily basis.
Awesome. So yeah, what would you say your experience is like in the annuities market?
Well, it ebbs and flows like a lot of other things, but as far as fixed annuities are concerned, really the most important thing is interest rates, and we are in a very interesting interest rate environment right now. Actually, I write a weekly newspaper column called The Financial Wave. I wrote a column about high pointing interest rates. So most people have been tracking this, but the Federal Reserve actually kept interest rates, short-term interest rates, the same yesterday. However, they've raised them in 10 out of the last 11 sessions. They meet every 6 weeks, and these are the highest interest rates we've had in the last 20 years. So there's a major opportunity, for brokers to capture the market.
Yes,
and
absolutely.
And help people.
Actually, I was just talking about that this morning with my husband. So he just purchased his dream car. He bought a 50th anniversary Hot Wheels edition Camaro, and he was just talking about how high his interest rate is going to be on this vehicle. And I'm like, oh my goodness, because I purchased my car last year and my interest rate was about 3.5% or something like that. And he's paying 9% now on his interest for this vehicle. So it's crazy to think about how quickly the interest rates can change. And so it's really important for agents and brokers to be taking advantage of the state of the market and just how they can really help benefit their clients.
I agree 100%. Love Detroit muscle cars. And, the interest rates, there's such a ripple effect on when they change interest rates. You hit the nail on the head. It's auto loans, it's student loans, the mortgages has a huge effect on the real estate industry, and the insurance industry is affected as well.
Yes, absolutely. Well, why don't we go ahead and dip into some insurance? So my first question for you is, what is an annuity?
As far as, fixed annuities are concerned, really there's so many benefits to them, but I'll try to keep it to 5. I may give you one bonus. So the first thing is guarantees. And one of the reasons why fixed annuities are under the insurance license, the life insurance license, is because there's protections and guarantees. So the interest rate is guaranteed and the principal is guaranteed. So technically, it's not a pure investment where you can win or lose. You're always going to win with a fixed annuity. Yeah, so guarantees are number 1. 2, tax deferred, very important. It's not what you make, it's what you net after taxes. So when you're planning, regardless of age, you want to try to either eliminate or defer taxes. And that's one of the major components of a deferred annuity, a fixed annuity, or an indexed annuity, which all fall under the fixed annuity umbrella. So one of the advantages is tax deferral. So a lot of times I like to compare it to a CD because people have money that they're willing to risk, and then what we call their safe money. So with safe money, important to you don't want to pay tax on it. So just as an example, most insurance companies are going to give between 50 basis points, and again, 100 basis points equal 1%. So for those that may be new in the business, so 0.5% is 50 basis points. So one of the benefits that insurance companies give their clients and customers is that there's going to be between a 0.5% and 1% higher interest rate than the banks are giving with CDs. And another thing is that with bank CDs, whether you take the money out or not, you're forced to pay the tax. You get a 1099 at the end of the year. So, that's slowing down your growth. So you get compound interest on a fixed annuity and you're not paying tax. So if you did a side by side, even at the same interest rate, an annuity versus a CD, the annuity will outperform it all day long.
Oh, yeah, because especially with the way that the interest rates impact both of those different types of products, is that with the annuity, you're going to get the compounded interest and it's going to grow much quicker. And then with the tax deferral, it's kind of just like a win-win situation. But so tell me next, who is the owner of an annuity from like a definition standpoint?
Before we get to the owner, I've got 2 more benefits coming.
Oh, okay. Well, go
Let's-
ahead and rattle them off.
yeah. The owner is the one who's the big winner. Yeah. So no fees. Okay. Very important to understand. And it's also important, especially for newer brokers, to understand, fixed annuities versus variable annuities. There's a lot of what I call noise out there. Like Fisher Investments in particular has made a career on slamming annuities. So you see all these commercials, 10 reasons to avoid annuities. And for the most part, first of all, they're talking about variable annuities, which do have different layers of fees. But fixed annuities don't have those fees. So one of the biggest advantages on a fixed annuity is that there's no fees. Again, it's like I look at it like you have a boat and fees are little holes in the hull, the bottom of the boat. So, how fast can that boat go if it's getting bogged down with water's coming in? So, no water coming in on fixed annuities because there's no fees. Protected from creditors, very important. We do a lot of business with lawyers and law firms, personal injury lawyers, for example. And so they get settlements, in some cases, very large settlements for their clients. And in some cases, the clients don't have any money. And I try to explain to people, doing this now, my company I founded my company in 1999 to quote the great Prince, we've been partying since 1999. What I try to explain is that if you have no money, your problem is you need money. So, but when you have money, your problems don't necessarily change. I mean, they're not eliminated, they change. So when someone is in particular, like a lot of times you have an accident and they get a large settlement, and if the client is unsophisticated and doesn't have a lot of money, I mean, fixed annuities are a great place to put them. One is because the average person that gets a huge settlement or wins a lottery is broke in 5 years because they blow the money. Also, it's protected from creditors. Again, it's insurance-based product. They're only when you have money that really there's three major possible catastrophes on how you could lose your money. One is losing all your money in the stock market. Two is getting sued, getting a car accident, possibly get sued. And three is you have a situation where you may have someone trips, falls. So not only will you have a lawsuit, but you have to hire attorneys. So you want to make sure that your clients are protected no matter what happens. So being protected from creditors is a huge benefit for fixed annuities, and it's a safe place to put them. And so if something happens and people are coming after you as far as lawsuits, you don't have to, they can't get at that fixed annuity. And then I would say that I'll combine the last two. It bypasses what's called probate. So especially for the newer reps in the business, probate is when someone passes away. Probate is the act of proving the will. So what happens is anything that doesn't have a beneficiary goes into probate, which means you're paying legal taxes. Also, there are actually cottage industries where you can go to City Hall and look up, it's public records, what someone had in probate when they pass away. So there are people that will go to City Hall and take a look. Oh, let's see what this person had. And they have real estate. Well, it looks like they're not going to have enough money to pay the probate fees or the estate costs. Let's see if maybe they'll sell the real estate at a 50%, like out of desperation. So anything that has a beneficiary, any investment or product that has a beneficiary will bypass probate. And that includes not only fixed annuities, but bank accounts. So like if you have an account at a bank, you want to put what's called a TOD, transfer on death, to it. So that's considered a beneficiary. So bypassing probate is very important, and a designated beneficiary. The last thing, the annuity is really the fixed annuity and life insurance for me is the most flexible product available in the marketplace, because you never know what's going to happen with life. So you want to, as life changes, your finances are going to change. So it's good to have a situation where a product has some built-in flexibility. So with a deferred annuity, you can just take money out whenever you choose to, randomly, or you can take an income. You can take a guaranteed income for life that you can't outlive. So it's the only product that allows you to do that. So really, those are my 6 biggest benefits of annuities.
Yes, I agree. Actually, I'm glad that you brought up your point about probate, because when my husband and I, when we bought our house, we actually bought our house from his grandfather, and his grandfather was, obviously creeping up there in age, and he was starting to, become a little bit more ill. He did have a couple of health problems, such as dementia, Alzheimer's. So when we were going through the house buying process, the gentleman who was facilitating our house closing said that because the house was not in his living will, that the house would have had to go through probate first, and we would have had to pay all these probate fees, and it would have been a much harder buying process. So my husband's aunts that were there at the closing with us, they were like, oh my goodness, we are so glad that we did this before Dad passed away, because this would have just been a pain. So it's really important to think about those things when you're working with clients, because you're trying to help protect their value and their money. And whether it's a house or just any sort of income that they had or any sort of savings that they have, it's really important important for this annuity to be able to bypass those probate fees. And
Yeah, I couldn't agree. I couldn't agree more, Kelsey. And so, and you hit a good point, because to me, it's annuities. It's like, we'll talk about what they are, but really what's more important is what they do, and how to utilize them properly. And so it's good, for you to have learned that, and the easy way, without getting hit hard in the wallet or purse.
oh yeah, exactly. But yeah, so we've talked a lot about the benefits of annuities, but kind of give us like an elementary school definition of what an annuity actually is.
Yeah, an annuity is a contract between you and a life insurance company, where you'll put in either a lump sum or a systematic monies, or a combination of both. And then down the road, they'll give you an income or guaranteed interest where you can defer the taxation. So you have a lot of built-in flexibility with the product.
Awesome. Yeah, it's essentially used as retirement income, which is great. So it's a great alternative to a 401k, but based off of the other episodes that we've recorded and a couple things that we've learned along the way, is that an annuity is also a great option to have alongside a 401k account, because in general, the cost of living is going up, and we don't know what life is going to look like in another 30 something years. So by the time that I'm 65 and ready to retire, how much money am I going to need in order to, survive daily life, when every day is a Saturday? So it's going to kind of come down to, yes, you should have the 401k, because it's a great option to have your employer contribute to that account alongside of you, and then also have it grow. But then it's also really important to have that additional cushion in your nest egg by purchasing an annuity. So let's go ahead and talk about who is the owner of the annuity account.
Yes, the owner is the purchaser of the annuity, and that's the one that's going to be paying the premiums, and that's the one that can actually surrender the contract and pull money out of that contract. So the owner has the power, so to speak.
Okay. And so who is the annuitant?
The annuitant is usually the same person, but it doesn't have to be that way. So the annuitant is the person whose current age and life expectancy are going to be used to calculate the benefits of the annuity, and determine how much down the road that they're going to receive.
So would you say that it is more beneficial for someone to open an annuity account when they're younger, say like in their 20s and 30s, or is it more beneficial for someone to open an account maybe later in life, maybe their 40s, 50s, or maybe even their 60s?
That's a good question, and I'm going to say both, and I'll explain to you why. I started in the business at 22. I'm all fired up, and I'm going to these training classes. They're telling me how great Prudential is. They were much stronger than they are now, and I was my manager's like, listen, you have the benefit of time and the time value of money. Do whatever you want to do, but I suggest that you take $1,000, which is what you needed to this particular product, to open it, and then the minimum was $100 a month. It's just start with the minimum and just put away $100 a month. You'll be amazed at how fast that the money grows. So there's a rule, and a lot of people don't know it. I feel like this is something that should be taught in school. It's called the Rule of 72. Is it something that you've ever heard of?
I think we had briefly talked about it the other day, but I would love for you to kind of explain it further for our listeners.
Yeah, sure. And this is really important to know, especially for the younger reps and younger clients and customers. So the Rule of 72, it's a really good formula. It allows you to figure out, like, if you have a lump sum of money, okay, and we're not talking about taxation at this point. Let's just take taxation out. So you have a lump sum of money, and you want to figure out how long is it going to take for that money to double. Or you want to figure out what interest rate you need to have the money double in a certain amount of years. You divide it into 72. Like, for example, if you're getting 10%, you divide it to 72, the money will double in 7.2 years. So if you're getting, let's say you're getting 8%, the money will double in 9 years. So if you have a situation where you're at a certain age, let's say a client is, we'll say 45, and they want to retire at 55, you have 10 years. Well, you can figure out what interest rate you need to make that money double in that 10-year period. You got to get 7.2%. So I think it's important. And I think that should be taught like in grade school, because it's important for younger kids to understand that, listen, this is interesting, this time value of money. I'm only X years old. I've got all this time. I can start putting some money away now. It's going to be a huge nest egg down the road. And it's also important for long-term care. When I got into the business, the training was, protecting clients from dying too soon. And there's only really three things that can happen. It's either live, die, or become disabled. And you want to make sure that you're protected on all three scenarios with financial products. So you was dying too soon. Now the problem is living too long, because people are living a long time. And as people mature, and I'm not huge on the term seniors, because what does senior mean? I mean, you can get an AARP membership at 50 years old. So is 50 years old a senior? No. Then there are seniors. I mean, I prefer mature Americans. So the biggest fear and worry for mature Americans is the fear of what I call running out of money. And I've done a lot of seminars on this, and you see that the heads nod like yours just did. So, the annuity product is really the only product that allows you to guarantee you're not going to run out of money, because you can pick a life only option.
Yeah, exactly. I think that's really important to note as well, just because there was something that I'd heard about on the radio a couple of months ago about this older woman who was delivering pizzas for Domino's. I forget what state this was in, but she had actually fallen on somebody's front porch as she was delivering the pizza. And this person was just like, why in the world is this woman at 75 years old working for Domino's delivering pizzas? And it was because she didn't really have a retirement fund. So she wasn't able to even pay her bills unless she had a part-time job. So what she was doing was she was delivering pizza for Domino's. Granted, I'm one of those people that feels like I don't know if I'll ever actually be able to fully retire just because I'm just such an active person. Like I always need to be doing something. And when I was laid off during COVID, the first month was great. I was like, cool, this is like a vacation.
Yeah.
But then after that, I started to get really, really restless. And so I'm like, this is the true testament to me that proves that I will probably never be able to fully retire. I'll probably always need to be doing something, but I definitely don't want to be delivering Domino's pizza at 75 years old. But thankfully, the person whose house she was at was a very, very kind person and even started a GoFundMe account for her and was able to raise enough money to her to actually fully retire, and was enough for her to live on for the rest of her life, which thankfully, yes. But at the same time, we all can't just crowdfund our own retirements forever. This was kind of just like one of those special instances, but we can't just rely on other people crowdfunding our retirement. So it's really important to understand that, yeah, this stuff is not taught in school. I mean, this is like a whole nother ball of wax, but I mean, in general. And so I graduated from high school in 2010. And after graduating from high school, I felt like there were so many things that I just felt really cheated out of as far as my education. And I went to Dearborn Public Schools. And so, Dearborn Public Schools is ranked, relatively high on the scale of education, but I still felt like there were so many things that I didn't know and I didn't understand. We're not taught financial planning. We're not taught about interest rates or how to save money or how to buy a house, how to calculate your student loans. None of that is all included when you're in school. So things like this are really important to know. And the only time that you really will get the education on this is if you do work with a licensed financial planner or if you take a finance class in college. So, I mean, unless you have either of those two options, more than likely you're not going to get the education on that. So it's really important for people to realize the value of working with a licensed professional who can walk them through all the steps and help them maintain their wealth from the beginning of retirement into death. But yeah, let's go ahead and talk about who the beneficiary is.
The beneficiary is the person that receives the balance of what's in the annuity on the death of the annuitant and the owner. So they're the ones that receive the money, and they receive that money, and a portion of that money is going to be taxable. The gain will be taxable at that point.
So based on what you just said about the beneficiary receiving the balance of the annuitant's account after death, that sounds to me like life insurance. So even though an annuity is an account and is a contract with a life insurance company, what are the differences between an annuity and the life insurance?
Yes, that's a good question. They are similar products. You could possibly call them sister products, annuities and life insurance. So one of the differences, the question you had asked about the beneficiary with the life insurance, and again, the life insurance is the most flexible product available. The annuity, I believe, would be second if I had to rank them. But the life insurance will be tax-free upon death. So the only time Uncle Sam gives you a break usually is when you get hurt or you die. So it's like you get hurt, you get a personal injury lawsuit, there's no tax on that. And you can do what's called a structured settlement, receive money over time, and there's no tax on the interest on that either. And a structured settlement is actually a form of an annuity. So the life insurance is tax-free at death, where the annuity would be tax-deferred. A portion of it would be taxable. And there's also what's called an immediate annuity, where you're picking what's called a settlement option. You're getting income for life or over 10 years. And a portion of that money would be excluded from taxes, and that's called an exclusion ratio. So depending on how old you are, how much money's in there, how much interest has been paid, a portion of that monthly income would be not taxable. So the difference between the life insurance and the annuity, although they're both under the life insurance umbrella, it's going to be on death, and also flexibility, because the annuity, 100% of the annuity money is invested. So there are no management fees in fixed annuities. And that's a big difference between fixed annuities and variable annuities. With life insurance, there's a cost for the actual insurance. So a portion of the premium that goes in goes toward the insurance cost, and then the balance is invested. So A portion, usually we use the number about 90% over time. So figure 85 to 90% of that premium would be invested on life insurance, and with the annuity, all the money's invested. So there are subtle differences.
I like that you were able to kind of outline the differences between the two, because I feel like a lot of people will tend to kind of confuse them, especially when it comes to the taxes. Because I mean, even as an adult, I'm still like, okay, how do taxes work again? I'm like, I just know that every spring I get out my TurboTax and I put in all my information, but there are still so many things that I feel like as Americans we don't understand about how our taxes work. So it can be really confusing for a lot of people to not know how to adjust their income when it comes to an annuity. So actually, speaking of income, let's go ahead and talk about how our annuity premiums paid. So we have single premium and multiple premium contracts. So explain to me the differences between those.
So yeah, so depending on your situation, there are people that will just, look, I have a lump sum of money and I just want to lock in a high interest rate right now. For example, interest rates, you can get over 5% guaranteed for 5, 7, or 10 years, however many years you want to lock it in. So there's lump sum, then there's systematic, where people are just going to put in like a systematic savings plan. It's like they're setting up, we call it a personal pension. You're setting up your own pension plan where you can put in X amount of dollars a month. There are people that may not have lump sums to start it, or you can do a combination where you may have a couple of thousand laying around, start it with that, and then put in, a few $100s a month, whatever it is that you can afford. So you have flexibility. And again, not every annuity allows you to do that. So you have to choose the annuity based on what the objective is of the customer or the client.
And I think that that's super important for our agents and brokers to know, is that they have to be able to learn more about their customer or their client in order to be able to make the product recommendations that are right for them. Because sometimes what happens is that you'll get really excited about a certain product or a certain carrier, and you'll just kind of like want to jump in and start promoting this product to everyone that you kind of come into contact with. But at the end of the day, you really do have to ask those great hard-hitting questions and be able to make the recommendations for your clients that is going to be right for them. Because at the end of the day, if you have a client that feels uneasy about the decision that they're making because they feel like they don't have all of their questions answered or they don't have all the pieces to the puzzle, they're going to kind of like freak out, and then they're not going to want to keep this account, and then you'll end up getting a chargeback, which is not what we want. So we want to make sure that we are giving our clients all of the benefits that they want without any of the repercussions that they don't want. And so speaking of benefits, when are the benefits paid? So we have immediate
Before you get to the benefits, I just wanted to comment on what you just said, because I have an extensive training background of training brokers.
Mhm.
So what you talked about, first of all, the most important thing you can do is ask good questions and listen.
Yes.
My mother used to say you have 2 ears and 1 mouth. You should be listening twice as much as you speak. And when you're speaking, you're repeating what you already know. So you can't learn something while you're speaking. I find that especially, one of the differences is there are what's called transactional brokers, where you mentioned what we call product pushing, or peddling, we used to call it back in the day. You're peddling policies. This is a long-term planning career. So you want to find out, you're pushing interest rates. Well, the interest rates aren't going to be great the next 30 years. We have a window right now where they are good. You want to find out what's the client's objective in the long term. The reason I actually got the nickname of the insurance doctor wasn't something I actually thought about, but a client said it. I went in to see a client, and I went in with, a lot of people have these like, the fact finders and your computer inputs and outputs. I'm a little bit of a hybrid of old school and new school, but I go in with a pad and I'm just asking questions. It's very non-threatening, and I'll talk about whatever they want to talk about first. You want to talk about your kids? Great. You want to talk about your work? Fantastic, because I need to know about your kids and how you want to plan for your kids, and I need to know what you offered, through your job. So I'd rather have a 10-minute debriefing on what's important to you, what your accomplishments are, than start pushing benefits and features of products, because I don't know exactly what we're going to recommend just yet. And also, it should be a 2-step process in most cases, where you're going to, the first meeting is just going to be an introductory. You're going to get to learn about them a little bit, let them know a little bit about you, get comfortable, and then come back with recommendations. And one of the things that we do is we'll recommend 2 or 3 different products, and also explain to them how the insurance company makes money. So when they understand the insurance company, how they make money, everything becomes easier, and you're not selling it, they're buying it. And there's a difference, Kelsey.
Oh, absolutely. 100%. I actually will use this as an example, is that way long ago when I worked in retail, I started working at this place called The Body Shop, which was kind of like an organic version of Bath and Body Works. In order for me to sell the skincare products, I had to learn more about my customer. I had to ask them the right questions. Where do you feel that you get oily most throughout the day? What are your skincare issues that you might be experiencing? Do you have cystic acne. And just like asking the right questions so I can get the right answers in order to make a recommendation for a product that's going to make the most sense for them. Because if I'm just saying, oh, yeah, you want this product because it will do this because I really like it. It smells nice, whatever. They're going to be like, okay, well, there's no benefit for me in that sense because I don't feel like that is going to solve any issues that I have. But it's like if I wasn't asking the right questions, then I don't know what issues that they have. So it'll be harder for me to make a recommendation for a product that is going to make the most sense for them, that they're going to love, and they're going to continue to come back and repurchase.
Yes, absolutely. And there's an art to asking questions. So, one of the recommendations I would make, especially for new brokers, it's obviously you're not going to know when you first start what questions to ask, but try to avoid yes or no questions, feeling questions. How do you feel? How do you feel about, like you touched on retirement before, like you just told me how you feel about it. So like what you said before, that's important. Because if you say, I don't see what the benefit is retiring. I have clients that retire and then they start aging really quickly and they have all this extra time and now they have to like reinvent themselves. I mean, sometimes you could lose your sharpness. So for me, like, I don't really ever plan on retiring. I think it's the beginning of the end, and maybe I'll just not take any clients, or maybe I'll, do something else. I actually run pizza crawls. It's funny because you mentioned pizza before. I run pizza crawls and I write a pizza column, a monthly column called This is a Slice of Queens. It's a Queens-based magazine that I write it for. So these are things that I'll do more of down the road. And should I decide to, let's say, leave or stop taking on new clients in the insurance industry, then maybe I'll do something else like that. But I don't think I'm ever going to retire. So if someone says they never want to retire, that's important because they may not need as much income down the road as someone that's going to retire and stop working at all. So these are important questions to talk about.
Oh yeah. I think that, like you said, with the retirement, there are some people that might not need as much retirement income as others just because, yeah, they might want to work part-time, or even if they're not working and they don't receive an income, maybe they'll be volunteering somewhere. So if they're volunteering, obviously they're still going to need, a larger income than if they were working part-time. But in general, it kind of just comes down to the person, and you can't generalize. You have to ask the correct questions, and you do have to be a great listener. And we actually just did a podcast episode on 10 ways to be a better communicator. So I think that kind of ties in with the entire industry and how if you're asking the right questions, you're able to get more out of your client. So then you can make better recommendations for them. And then they're going to refer you to other people. And then that's just going to continue to grow your business. So the more educated that you are and the more passionate that you are about helping people and finding out about how these products can really help benefit your clients, that's really what's going to help grow your business.
Yeah. I mean, it's all about the education. And that's why my clients like, wow, you come in with a pad. It's like, we're filling out like the initial questionnaire. It's like you're a doctor. It's like you're the insurance doctor. I'm like, that sounds kind of good. It's also important when you're just like, when you're first sitting down, or maybe they give you some water, have a cup of coffee, whatever it might be, ask questions not only about about the family, parents, possible, there's a situation where there could be inheritances coming down the road, health issues, very important. I know that you have a situation where you have there's a big market for Medicare and Medicare supplements. I actually just did a class for Medicare brokers and tried to explain to them, like, when you look at a Medicaid application, there's a lot of different things that you fill out on that application that could open up potential sales for annuities and life insurance settlements and estate planning and other things that you can kind of key in on just by taking that information down off the application. So it's just important to, ask questions, but in a non-threatening way, and just get to know the people and, what they see. Where do you see yourself 10, 20 years down the road? Is there any problems with your family? Do you have any situations where you may have disabled people in your family or parents that you may have to take care of down the road? So these are important aspects of what could happen down the road, and that also would come into play when you give a recommendation as to how much they may want to put in that annuity. Because just like every financial product is going to have upsides and downsides, and I guess the next section will talk a little bit about that as well.
Absolutely. I think that maintaining a curious mindset is what is going to help any broker maintain a better relationship with their clients. So let's go ahead and talk about benefits. So when are benefits paid? So my first point here that I have is immediate or deferred annuities. So when would someone want to purchase either type?
Okay, well, deferred annuities, I mean, we touched a little bit on it before. So the younger person that buys a deferred annuity is in great shape because they have time on their side and compound interest. So if they're getting, interest rates are getting close to 6%. I mean, if the Fed bumps them up, let's just go easy math. If you're getting 6%, You divide it into 72, that money's doubling every 12 years. So if you're 20, just do the math and keep going by 12. I mean, you're going to have big money when you're even by the time you're in your 40s. And for the older people, there's a financial planning rule. It's called the rule of 100. Have you heard of it?
No.
I love it. It's all good. So the rule of 100 is you take the number 100 and you subtract your age. And then that's the maximum amount of money that you should have with market risk in the market. So if you're 20 years old, 80% of your money in the market is okay, because if the market goes down, you have time to recap it or to make that money up. But as you get older, you should have less of your money at risk and more safe money, which is where the annuities would come in. So it's called the rule of 100. It's a little bit of a basic rule, but it is good to understand that as someone gets older, they should be taking the risk off the table.
I agree. I think that is something that's really important to know as well, just because with the state of the market right now and how 401k investments or just 401k accounts have lost a lot of money over the course of the last 3 years. I think I've said this now in like the last 2 or 3 podcast episodes that my mom is very upset about the fact that she's lost quite a bit of money out of her 401k just with the state of the market. So the fact that annuities will help kind of protect you from the market risk is another huge benefit as well. So my next question is, what is the average life expectancy right now?
It was going up every year, but actually in 2022, it went down 1 year, and that's because of the COVID deaths.
Mm-hmm.
But in years when I first started in the business, it was in the 70s. I'm dating myself a little bit, but it was in the 70s. It was 74 for men and 78 for women. And actually, no, 79 for women. It was a 5-year gap. But as things have changed, and a lot, you have more women in the workforce and, more Mr. Mom type things. As things have changed, like the gap has gotten a little smaller. So there's about a little under a 4-year gap between women and men. So you're looking at about 77 and 81 is currently going to be your life expectancy. But, it's funny. We were talking about this at the baseball game last night. My father's 81 today. And, we were just talking about, life expectancy, how long you're going to live and how many years you're going to go to these games. And I told my brother, I was like, if you knew when you were going to die, planning would be really easy. You figure it all out. So I said, for me, I'm living as if 75 is going to be my cap. And he's like, what do you mean? I was like, I have things to do and I'm working backwards from 75. And I'm going to assume maybe the last couple of years aren't going to be so much fun. I may not be able to travel or be in good health. So there are things that need to get done now. So it's important to, sometimes people don't want to talk about it. Some do, but I found that the death conversation, I wrote a column of the silver linings of COVID. And there are some positives where people are a little more openly talking about death and mortality. And, it makes it easier for us to plan, because there are, when you're meeting with clients, there are the type that like the old school, like, listen, we had no money and whatever they get is more than they would have had before. So, and we're not telling even what we have. And there are others that want the children in every meeting and look, here's the plan. So you don't know, there are a lot of difference. Some of it's cultural. So there are a lot of different beliefs. And these are things that you have to take into consideration when you're doing your planning as how do you feel about mortality and retirement?
I think that's really important to note as well, because like you had said before, it's all about understanding the feeling behind it. As a digital marketer, I do a lot of research on how to improve social media marketing and social media reach in general. And a lot of what I've been finding recently, watching videos from other creators and industry experts, is that it's all about how you're able to make that person feel. It's not necessarily about having great content and giving like tips and hacks and all this other stuff. It's more about how are you making that person feel? How are you able to identify what their issues are and then being able to help solve them and create a solution for them based on how it's going to make them feel in the end result? How do they feel now? And how are they going to feel once you're able to provide them with this solution? And so I think that's really important to note.
Feelings are critical. I mean, there's a saying in sales, and I've had a lot of different types of training, communication, sales, and there's a saying, an undisturbed prospect will not buy. That goes into feelings. And also nonverbal communication, something I do want to bring up. It wasn't something I was thinking about, but just based on what you said. But I took a communication course, which was really interesting. And they talked about the differences on how you communicate nonverbal, tone, and verbal. So a lot of people don't know this. So 55% of communication is nonverbal. So it's body motion. So when you're talking, you're asking them questions, if their arms are folded, you're probably not doing so well. And, you may need to, stop talking about business stuff and get back into, talking about them as people and social things before you get into your business portion. Then there's tone, which is 38%. It's the tone of your voice. So the actual spoken word is only 7%, which to me is very interesting. So when that's why I like video and role play, and you have to change it based on their physiology and their nonverbals.
Oh yeah, absolutely. Have you ever heard of social psychologist Amy Cuddy?
The name rings a bell.
You'll have to go look up her TED Talk on YouTube. I had actually first heard of it when I was in college. I had a business writing class and my professor played her TED Talk for us. It's about 20 minutes long, but it's the most enlightening 20 minutes of my entire life. And she talks about how our body language not only impacts how other people are going to respond to us, but it also has a chemical impact on our brain. And how if you are sitting like more closely together, like arms folded and like
is she calling it dopamine?
It has to do with cortisol and testosterone. So when you are more closed off and like, sitting closer together with your extremities closer to you, legs crossed, it can boost your cortisol level. Which is the stress hormone, and then it will decrease your testosterone levels. But you want to expand yourself, take up more space, have your extremities and your legs a little bit further away from you and do power poses for at least 2 minutes in order to drop your cortisol levels and then to boost your testosterone levels to help you feel more confident and powerful. And I've even read her book on it called Presence, and the science behind it is completely fascinating. So I definitely think that you need to go read her book, watch her TED Talk, because it's absolutely amazing. And I also like what you said about tone. We always say it's not what you say, it's how you say it. So understanding how other people's body language is not only impacting what you should be saying to them, but also understand that how the way that they're sitting is making them feel. So if they're sitting with their arms crossed, not only are they kind of like tuning you out a little bit, but they're also becoming a little bit more stressed because that cortisol level is going up and their testosterone is going down. So making sure that you're able to read those nonverbal cues is something that's really important.
Yeah, that's great stuff, Kelsey. And also, just to piggyback a little bit on that, there are situations like if their arms are folded, you need to change your questioning, but also there's a technique called mirroring where they're sitting a certain way. And if you sit the same way, you'll get them to move. So if they have their arms crossed and you cross your arms, they'll make an adjustment. It's called mirroring. And it's a way to see if you can try to make them adjust or change their nonverbals.
Oh, absolutely. I find that I have to check in with my body language every now and again, because I have to make sure that if we're having a conversation about something important, like a task that I need to do, or if we're just exchanging information on how to grow the business, I have to make sure that I am sitting in a position that helps me feel more powerful and confident. Because if there is something that I'm like, hey, like we need to be doing this, like I want that to come across as that I'm the expert in whatever it is that I'm doing. And I know that you're the expert in what you're doing, but we need to be able to collaborate on this. And it just kind of helps to keep the communication lines open.
No question. I think also breathing is important, being able to control your breath. I read a really interesting book by a famous UFC fighter, the Gracie family, actually, Rickson Gracie. And it's called Breathe. And there was a lot in there about the history of mixed martial arts and everything else, but it was the fundamental lesson from the book is breathing. If you can control your breath, you can control your life. It was really interesting.
Oh, wow. Awesome. Well, here, let's go ahead and get back to some annuity questions.
Yes, let's breathe.
Here.
Let's breathe up.
Yeah,
Let's breathe.
I was going to say, like, I honestly, I could talk about body language and Amy Cuddy all day.
Our body language just both changed. I don't know if you noticed that.
Yeah. Actually, I did. I was like, okay. So my next question for you is, how is the money from an annuity account invested in today's market?
Well, what happens is when you put money with a life insurance company, they'll have a general account, and usually they'll invest that money separately themselves in bonds or other safe fixed instruments, because they need to make money from your money. So it's a good question, because it's also good to understand when you're speaking with potential clients. How does the insurance company make money? So look, if you're giving the insurance company a lump sum, and then like I had a situation, I got a call from a fee-based financial planner, which they're good for insurance brokers to know, because they take a fee for the advice. The client knows they have no axe to grind. They're not captive with a company, and they're just, look, here's what you should do, and I have the recommendation of the guy that can help you. So this is a woman. She had really interesting, 71, husband 75, based in New York City, where I'm located. And she worked for a hedge fund and did an amazing job, just, squirreling money away. She had $2 million, and she had never even made $100,000 in a year. And so but she didn't have a pension. Her husband had 2 pensions, and she wanted to take half of the money out and put it into some type of annuity to get income. So she puts that money with the insurance. So she's explaining to me, like, what are the fees? She was like, she couldn't believe there was no fee on an immediate annuity. And I said, well, let me explain to you how the insurance company makes money. So they're giving you a lump sum. You're giving them a lump sum, $1 million. They're giving you $6,000 a month. Well, they're making interest off the balance of the million minus 6,000 every month. That's 72,000 a year. They're making interest on that money. And they also have the time value of money. So they don't have to charge you a fee because they're able to get interest from your money and investing it in a side account. So that's how they get, that's how they make money off our money, so to speak.
I think it's really nice to be able to have the security of just that, hey, I'm just going to pay this insurance company however much money per month. And they're essentially just going to invest it and then grow my money for me, because there are so many people that would say like, oh, well, I could just invest the money in the stock market myself. And it's like, well, I mean, yeah, you can do that, but do you have the financial resources and the education behind being able to know when you need to be able to pull your investments out or when you need to stick with it? So it's important to be able to have that security of that, hey, like, if something kind of does end up dipping in the market, that I'm not really going to lose my money, especially if you have a fixed annuity as opposed to a variable. So it'll be important to note that as well. So actually that leads me into my next question is, when did you start seeing a trend of more people investing in fixed annuities versus variable annuities, or vice versa?
Usually there's a shift when interest rates change. So and stock market as well. So when interest rates are high, like now, people are saying, look, if I can get 6% and double my money in 12 years, like, why do I need to roll the dice, in the stock market? And you hit something, what you just said also, it's called set it and forget it. There's no maintenance on a fixed annuity. You know what the interest rate is going to be. You're not going to pay any fees. So there's no maintenance there. And if, you want to go in the market, that's fine with your risky money using the rule of 100, there's a percentage. Okay. Roll the dice with that money. That's fine. 70%, there's an index called the S&P 500, and just putting the money in that index with no management outperforms over 70% of advisors. So if an index is going to outperform advisors, as an individual that's not an advisor and they're going to manage their own money, it's almost impossible you're going to do really well doing it on your own.
Yeah, a lot of people don't get this type of education when they are in the school system. I mean, granted, most people take an economics class in high school, but it can be really hard to be able to understand the full picture of how the stock market works and really be able to understand where and when you should be investing your money, based off of a 5-6 month course in high school. It's just not enough. So working with a financial planner or financial advisor is going to be your best bet. Let's go ahead and move on to our next question. So how much should someone buy or invest into an annuity? So my first point is, depending on my needs or age, is the annuity right for me? Taking money out of an annuity may mean that you pay taxes, while also it's sometimes possible to transfer the value of an older annuity into a new annuity account, where the new annuity may have a new schedule for charges that could mean that the new expenses that you must pay directly, or they could be indirect as well. So kind of elaborate a little bit on that for me in terms of the taxes and transfer of annuity accounts.
Yeah, that's good stuff. So that's right up my alley. So right now, like I'm working on several cases where we're doing that, because again, you're talking about in 1 year, interest rates there's been a 5% gap. I mean, this hasn't happened in over 20 years. So this is an opportunity to go back to existing clients that may be getting 2 or 3%. I'm doing this with some of my own accounts right now as we talk. So what happens is, one of the good things and the similarities between, like you talked about life insurance and annuities. So an annuity, what you can do, and there are people, if someone knows anything about real estate, there's what's called a 1031 exchange. What that means is you can take a piece of property and buy a new property of like and kind quality with a similar price, and you can defer the taxation. It's almost like you're rolling over one house into the other. It's called a 1031 exchange. In the insurance industry, it's what's called a 1035 exchange. So what they allow you to do is they allow you to take an older annuity, which I'm doing with my own money and some of my family's money in addition to clients. Because with the annuities, usually you have a guaranteed interest rate period, which you decide at the inception of the contract, whether you want to lock it in for 3, 5, or 7, however many years, but then that rate's going to drop after that guarantee period is over. And there are a lot of people that don't shop it at that point. There are brokers that aren't on top of it to explain, to potentially do a 1035 exchange and move it into another product at a higher interest rate. I have a rate that dropped down because we just came off of the lowest interest rates in history less than 2 years ago. So people have a lot of accounts that aren't making big money. I mean, you're under 4%, 3, 2%. So you're doing a favor by doing a review with your clients, which should be at least every year or two. Right now, you can get between 5 and 6%. So why wouldn't you want to roll money out of an old annuity into a new annuity? Like, one of the downsides you did hit on is that, yes, there is a new surrender charge period. So you may be, past that period. So the question is, do you need that money? So you have to take into consideration what other liquid money they have. Do you have 6 months of your income in an emergency fund? What other assets do you have where you can afford to not pull any money out of the annuity and roll into something different? So it's called a 1035 exchange. So what's really cool, and a lot of brokers don't know, you can do annuity to an annuity, but you can also take the cash value of a life insurance policy and roll that into an annuity with no tax.
Okay, that's a
So
cool
like,
benefit.
so when you're reviewing policies down the road, because we do a lot of life insurance, which is very similar product to fixed annuities, as people get older, they may not have the same need for that insurance policy. They may have a situation where they're retiring, their income's going to go down. They don't want to pay that premium, or the kids may be well off and don't need the money on death. So in these cases, they can either A, sell the policy, which we can help them. That's called life insurance settlement. Or B, if you want to stop paying the premium, because some of the people they consider like a bill. If they have a whole life policy, that's, you're building cash value. So, okay, here's what we can do for you. How about we take the cash in this policy, roll into a fixed annuity. Now you're going to get interest on all the money. You're not going to have to pay the premium. And so you're not going to lose any money that goes into the cost of the life insurance portion. And you have a deferred annuity. You don't have to put any more money in, and you're going to get a higher interest rate. And you just got out of paying that premium. You just took a monthly raise on your net income. 1035 exchange is a nice creative way for deals, and it's good rules to know.
Oh, absolutely. I'm really glad that you brought up that portion about income and premiums, because that actually kind of like leads me into my next question for you was, how are you able to find out, I mean, other than just asking the right questions? So how much can someone afford to pay in premiums? So that in and of itself will kind of come into like their monthly income, but how will their annuity contract fit in with their total financial planning? So how is it that you go about making the recommendations for a product based on someone's income? So let's just assume that they have a salary of maybe $40,000 a year, which is below average in the state of Michigan. The average Michigan salary is about $63,000 a year, but most people that I know of are making close to $40,000 a year. So how would you make a product recommendation for someone with a salary like that?
That's a good question, and that's very important is your income, because saving money, it's a habit, just like going to the gym, it's building a habit. So if the people you have to take a look at, first of all, what are they doing right now? So if they're doing nothing, okay, you can't go from ground floor to, socking away 25% of your income. Plus you have expenses at 40,000, depends if they have a family or not. So again, I don't know some of those answers, but, I try to say, start slow, start with a low number. For people that are saving no money, start with 1% of your income and then try to raise it 1% per year. So it's baby steps. So it's, start with the habit. Just like you go into the gym, start twice a week. You're going to be sore. It's going to take a couple of days in the beginning. Your body's going to adjust, then eventually you can go, after, let's say 6 months, go 3 times a week, then go 4 times a week. Then maybe you're going to go 6 times a week, and you're going to break it up into different body parts every other day, so it's building a muscle. It's a savings muscle. So start slow, start with 1%, and then see if you can bump it up just a little bit each year, and, you're on your way.
That's a great tip to have as well. And I really like your gym analogy as well, too, because I also need to really get back in the gym. I was doing so good last year. And then once I've come back from my trip, I've gone maybe once in the last like 2.5, 3 weeks. So I'm just
Vacations
like,
will do that to you.
It does. It does. I just really need to get back on the horse. Mhm.
So you want to know, that's part of the questioning is, do you take vacations? And if you don't, why not? So it could give someone an incentive or a motive to put money aside just to take that vacation.
Oh, yeah. Well, since we were talking about vacations, it kind of like ties into that in regards to retirement and annuity planning, because I know so many people that over the course, especially I think over the course of the last like 5 or 6 years, there's been like a really big shift amongst people of my age or around my age where we're like, you know what? I don't want to wait until I'm 65 and retired to go out and travel. I want to go do it now when I'm like young and limber. And that was kind of my idea behind going on our trip. And it was so cool. But that was one of the things that I'm really glad that we did, because we had run into so many people that were in their 60s or maybe early 70s that were traveling, and they couldn't do as much because they had limited mobility. And even though they were still, pretty mobile, I had run into quite a few people that, were just having a lot of pain or just difficulty walking because of whatever other like health issues that they had. And just from, getting older, it just kind of just happens. The human body does eventually start to deteriorate as we get older. So we didn't want to wait. And so I think it's important to ask those questions to your clients, like, hey, do you want to travel now? Or are you planning on like doing all of this stuff like after you retire? Because that's going to impact how much money that they're going to be able to put into these annuity accounts.
No question about it. And, you hit the nail on the head there. So for me, like, like vacationing is a big part of my life and it gives me motivation. So I try to set up a trip every quarter, one big trip a year internationally and one trip a quarter, in addition to like weekends and stuff like that. So, when it's the insurance industry is not always going to be easy. You're going to have ups and downs. You obviously, you want to try to stay steady, both emotionally and, with your activities and your habits. But, if you're in a situation, I find just for myself, and again, not everyone's the same, but for me, like I'm going to visit a friend. I'm going to be in Northern California in the mountains in 3 weeks. So for me, like I lock in work wise, and I'm going to work backwards and figure out everything I have to do, because I don't want to do. I'm not looking to work much when I'm going to be in Northern California. So I'm going to do all my follow-ups and really lock in and concentrate and focus, for that trip. So if you're doing 4 trips a year, you're locking in before. And when you come back, you're locking in. So in a way, you're kind of nudging yourself to stay focused. And I'll take someone, and again, because I've seen the training, and I've had a lot of clients over the years that they're living below their means, and we're going to start traveling at 62, and then you have the health problem. Because again, as we talked about in the beginning, the 3 things that can get you is losing money in the stock market, bad health, and lawsuits. So I've seen people that have all this money and they squirreled away, and they've had not a fun life, and now they can't travel because whatever their health issue is. So do the traveling now, and it's going to help you keep your focus at work. And I'll take the person that works 46 weeks over the 52-week person, production wise, all day long, because you need to rejuvenate, you need to rest. Okay. And, I took this course called Strategic Coach in Canada, very interesting, mostly people in the insurance industry. And they talk about the opposite of what I was doing with Prudential, and how when I started in the business with Prudential, everything was brick and mortar. You had your general agent up here, your 5 sales managers, you had 10 sales reps in each staff, 12 admin people, and everyone's under the same roof. So you have the same people doing different things every day because there's different types of insurance. So he talks about setting up 3 types of days: a focus day where you're doing nothing but new business, a buffer day where you're working on your business but not in your business, and then a free day. And the free days are the hardest one to schedule. Like when you're on a free day, like you're not taking business calls, you're not reading periodicals in the industry. Free means free. So, it's important to plan yourself out, take these trips. It's all about quality of life. One of the best parts of this industry is that you have what I call time freedom and money freedom. You're not a 9 to 5. You don't have to have someone else's opinion for you to get a raise. You give yourself a raise by working harder, working smarter, or potentially upgrading your clientele base. So this industry is fantastic, and time freedom and money freedom, you can't get that in other businesses, Kelsey.
Oh, absolutely. I love that you brought that up too, because I think that that's something that a lot of people are pushing for in today's world, is a great work-life balance. And I think that especially when you're working for yourself, it does kind of like give you that. There are some people that are like, oh yeah, I have to treat this business like a 9 to 5 in order for me to give myself a good work-life balance. And then there are some other people that are like, well, I'm going to work 12 hours a day, 4 days a week, so then I can be off Friday, Saturday, Sunday, and that I don't have to worry about it. And you just kind of have to find whatever's going to work for you. But yes, like creating a schedule for yourself is really important, because if you don't, you're not really going to know what to do with yourself. I talk to so many agents that are just like, okay, well, what should I be doing to generate leads? I'm like, well, what are you currently doing? Are you kind of just like sitting at home on the couch, like praying for the leads to roll in? Or are you going out there and getting involved in your community? Are you networking? Are you talking to other people in your local area? Are you networking with other industry professionals? Are you setting up referral partnerships with local pharmacies or other local businesses? If you're not doing those things and you're not setting up a schedule and going out and chasing the things that you want, I mean, granted, I believe in manifestation, but in order for things to manifest, you also have to put in the work to make them happen.
No question. And, marketing is very important. I was a marketing major in college. And like we talk about, like, you're building, let's say, a table or a foundation. You need multiple legs to keep that table up. So you need to have at least 4, if not more, different avenues of where you're getting business from. And you got to go out and get that business. And there are different ways to do it. And I always also, I call it following your passion. Do things you enjoy doing, and people will see your passion, because people do business with people they like. That's the number one factor, is being comfortable and liking the person. As opposed, you can have the best product knowledge in the world, but if you have no one to talk to, there's a saying, knowledge is power. I disagree with that. Applied knowledge is power. You've got to apply the knowledge. And if you have no one to talk talk to. It doesn't matter what you know. Products are sitting on a shelf. They're not doing anybody any good. So do things, set up different things that you enjoy doing. Like I just picked up a new client from a pizza crawl that I did. We do sports. I mean, hobbies, get involved in chambers of commerce. It's also very important to have a good mentor in the industry. I was lucky that I had a really good mentor in the beginning. And then I had a great mentor a few years later, a gentleman by the name of Erwin Smiley, rest in peace. But he was an older man, and he was he's an icon in our business. And one year he led 3 different companies. And one of his claims to fame is Ralph Lauren was his client. He did the estate planning for Ralph Lauren. So, and he taught me things. So he saw I was a hard worker. I was a young kid at the time in the same office as him. And when all the staff would leave at 5:30, sometimes I would go in there into his office, and he would like give me tips. He's like such a wonderful man. He was an older man in his 70s and just a wonderful person. And he told me certain things that I live by today. One is, don't let any one client get you upset or worked up, because no one deal will change your quality of life. So don't get yourself crazy over one. And that's trying to keep it even keel. But these sayings, like, they stay with you. So, if I had to give some advice to younger reps, find a good mentor.
I was actually going to, that was going to be my next question for you, was what advice do you have for agents that are either new to the field or even seasoned agents who are looking to add annuities to their product portfolio or even make more sales? So I'm glad that you brought that up as having a mentor.
Mentor's good. Also joint work.
Mm-hmm.
A lot, just like sports. I mean, we went to a baseball game last night. I took my father, my brother to a game, and this player in the Yankees, this kid Anthony Volpe, he's 21 years old, and he's in the major leagues, and he's learning on the job. He just changed his batting stance because he was in a big slump. So, like, you can drift into habits and you don't realize you're doing it. And so when you have a good mentor or a manager, or you're doing joint work, it helps you focus, and you're learning from other people. So, like, for me, like training, like, even this, like, if I'm doing a pizza crawl, or I'm doing workshops, seminars, I'm doing podcasts, I'm always learning something from the other person. Like, you've already taught me things today. So, like, I write a monthly pizza column in a magazine. I write a weekly Financial Wave newspaper article. It keeps me sharp, and you're forced to research. It keeps you definitely current and sharp.
Oh, absolutely. I think that doing research is something that's very important to every industry, because I mean, shoot, it's not like I learned in college how to develop a social media marketing strategy. Like, that's all stuff that I had to learn myself. I had to go out and I had to go do the research. I had to look at multiple different resources in order to develop something that I felt like was going to work for my workflow, but also was going to help bring our clients the results that they want. So it's all about a matter of doing the research and becoming more passionate about it, and educating yourself and trying to find those great educational resources, which I'm glad you brought up.
Self-improvement, very important. Take classes, get designations. You meet people from, I met when I started taking what's called LUTC, Life Underwriting Training Council Fellowship. I'm a certified senior advisor, a chartered life underwriter. You learn, but you also meet people from different companies and different, and you learn a lot from people. So, take the courses and take different types of programs to improve yourself.
Oh, absolutely. Not like we said before, applied knowledge is power. But yeah, so I'm just going to go ahead and rattle off some quick 5 annuitant considerations. So these are some things that you can kind of help teach your clients. And number 1 is, don't follow the first contract that you're offered. Take your time and shop around. That's something that agents and brokers can really help kind of educate their clients on, is that, granted, I might be able to make this great product recommendation for you, but at the end of the day, I want you to be able to do your own research, ask me more questions, so then you can make an informed decision. Next is to compare contract summaries and policy benefits for similar contracts from several different companies, which is also where a great financial planner and advisor comes in, because you're able to choose the one that best fits your needs at the most favorable premium rate. Next is to ask questions. Your annuity contract may represent a considerable investment and may significantly impact your family's future. So making sure that you're asking questions, and the right questions at that, and to be certain that you understand the effect of all charges and penalties that you may incur under each contract. So again, that's where the knowledge of a great financial planner and advisor is really going to become valuable to that person. And then if you're buying an annuity for an IRA or other tax-deferred retirement program, make sure that you are eligible. Also, make sure that you understand any restrictions connected with the program and to ask your accountant about any potential tax consequences. And we've talked a lot about taxes and tax deferral during Annuity Awareness Month here on the Direct Insurance Podcast. So I think that it's very important for that to be brought up more than once in any annuity conversation or any retirement planning conversation with your clients.
Yes, I agree. And one of the questions, you may want to ask in the beginning, who's handling your investments now? Who's handling your insurance now? It's always good to get the CPA involved. If they're conferring with the CPA, you want to reach out and speak to the CPA yourself if possible. Look, I'd be happy to talk to him or her. And yeah, that'd be great. I mean, answer any questions they may have. That'd be awesome. And it's, that's a center of influence right there. And, you do a good job at that CPA and they start sending you some other people. So advisor driven business is a really good way to go. CPA or attorney or, other advisors. Great way to do business.
Oh, yeah. And that's why I tell our brokers all the time, I'm like, you need to be networking with other industry professionals or even other industry professionals that are adjacent to your industry. So like you said, those CPAs, that's a great way to generate referrals for your business.
100%.
But thank you so much, Robert, for joining me today. I really enjoyed this conversation. I learned so much from you. And thank you, all of you guys out there, for listening today to the Direct Insurance Podcast. I hope you also learned something new because I know I did. And to view this podcast after it airs, you can watch it over on the IAD YouTube channel. And speaking of YouTube, make sure to follow Insurance Advisors Direct on social media. We are on Facebook, LinkedIn, YouTube, and TikTok. Rob, where can people find you if they want to get in contact with you?
Yes. Well, you can call, I don't know if you can see my billboard behind me, but you can call me at 917-359-3985. You can email me at rob@insurancedoctor.us. U as in United, S as in States. Or you can go to my website, www.insurancedoctor.us.
Awesome.
Where
Awesome.
I've got a lot of articles on there, articles on annuities and other things. You can see my commercial, other things, a very educational website.
Oh, awesome. Okay. Well, if you are an independent agent or thinking of becoming an independent agent and are looking for an industry partner, we here at IAD would love to be considered. And if you want to learn more about IAD, you can visit our website at www.iadbrokerage.com, or you can call us toll free, 1-800-381-0977. Thank you so much again, Rob, for speaking with me today. And I look forward to seeing you again soon.
My pleasure. Thanks for having me, Kelsey.
You're very welcome. Bye.